In the early hours of September 16th, 1992, the British government found itself bleeding money at just an unimaginable rate.
Oh yeah, it was absolute chaos.
Right. We're talking about billions of pounds literally evaporating in a single afternoon. The Chancellor of the Exchequer was sweating, the Bank of England was desperately buying up its own currency, and, well, a single hedge fund manager named George Soros was essentially breaking the Bank of England.
He really was. And the wild part is the politicians thought they were fighting this rogue speculator, you know?
Yeah.
But in reality, they were fighting a mathematical equation.
Exactly. They were caught in this inescapable trap of an economic model that dictates exactly how money, interest rates, and trade flow across borders, and they lost.
Massively. And that 1992 Black Wednesday crisis, it's like the ultimate cautionary tale for policymakers who believe, that political will can somehow override the fundamental laws of open economy macroeconomics.
Right. You just can't rig the system when the global financial market is larger, faster, and honestly more ruthless than any sovereign central bank.
You really can't. And that's exactly why we're starting there today. Because understanding those underlying laws, it isn't just about passing an exam. It's about understanding why nations rise, fall, or just suddenly find themselves staring down a sovereign debt crisis.
Which brings us to the actual stakes of our mission for you today. Because if you're tuning into this deep dive, you are likely in the final stages of preparing for the GE-02 Paper 2 exam for the Indian Economic Service.
Yep. And we are taking a massive, comprehensive dive into open economy macroeconomics and the balance of payments today.
And just to be clear, we are dispensing with the surface-level definitions. Like, you already know what a tariff is. You know what an exchange rate is. Our goal today is to really examine the structural anatomy of an open economy under extreme pressure.
Right. We need to dissect how the internal plumbing of a nation reacts when a huge shock hits the system.
Yeah.
Because the examiners for the IES, they are actively looking for that level of depth.
They don't just want bullet points.
Exactly. They are not testing your ability to just recite the components of the current account. They are testing your diagnostic capabilities. Like, when a country devalues its currency, they want to see if you can trace the exact chain reaction through the goods market, the money market, and the foreign exchange market.
All while accounting for friction, right? Like capital controls or sticky wages.
Yes. They want to see the complete mechanism.
Okay, so let's unpack this. Because we have some serious anchors from the past year questions to guide us. We're looking directly at the 2025 IES question that demanded a rigorous examination of the ISLMBP model under fixed and flexible exchange rates.
That was a tough one.
It was. And we're also going to tear apart the 2023 question that asked for a full breakdown of the Marshall-Lerner condition.
Which is crucial. The source material we are working through today, it covers the fundamental mechanics of the balance of payments, the brutal realities of structural adjustment, and the absolute constraints of macroeconomic policy.
But before we get to the really high-level policy traps, we have to look at the ledger itself, right? We have to look at the balance of payments.
We do. Because the entire field of international macroeconomics rests on the foundation of the BOP. It serves as the ultimate diagnostic tool.
Right.
A nation's balance of payments is basically a systematic statistical record of all economic transactions between the residents of the reporting country and the rest of the world over a specific time period.
But treating it as just a simple accounting sheet kind of misses the point, doesn't it?
Oh, completely. It misses the profound economic narrative embedded within its structure. The BOP is divided into 3 primary accounts, and each one tells a different story about a nation's economic behavior.
Right, so the most visible of those, the one that generates all the political headlines, is the current account.
Yeah, the famous trade deficit arguments.
Exactly. This is the domain of real sector flows. When politicians are arguing on TV over trade deficits, this is the territory they are fighting over. But the current account is significantly more complex than just, merchandise being loaded onto cargo ships.
Right. It captures the trade balance, the physical goods, but it also captures the invisibles.
And those invisibles are often the dominant economic driver, right? Particularly for a service-oriented economy. Like software exports, financial consulting, tourism, these are all critical service exports.
They absolutely are. But the current account also goes deeper into income flows. So we have primary income, which represents the return on the factors of production.
Like what, specifically?
Well, if a domestic resident owns shares in a foreign corporation and receives a dividend, that inward flow of capital is recorded here. Or, conversely, If a foreign national is working within your borders and sending a portion of their wages back to their home country, that outward flow is recorded as primary income.
Got it. And then we have secondary income, which I find fascinating because it captures transactions where nothing of direct economic value is actually provided in return.
Right. Unrequited transfers.
Exactly. This is where we find international aid, but more importantly, especially for the Indian context, remittances.
Huge stabilizing factor.
Massive. Like, think of a structural engineer from Kerala working in Dubai, sending a portion of their salary back to their family in India. That single mechanism is a massive macroeconomic stabilizing force.
It really is. And just to ground this in the recent data from our sources, India's current account deficit, the CAD, was hovering around 1% of GDP in the fiscal year 2024.
Which is an incredibly manageable figure, right? It reflects a relatively stable external position.
Yeah, it's very solid. But a deficit in the current account inherently implies that a country is importing more real value than it is exporting.
Right.
And mathematically, that deficit must be financed somehow.
Right.
Which brings us to the subsequent accounts. The modern IMF methodology strictly separates the capital account from the financial account.
Let's clarify that separation, actually, because I know a lot of older textbooks tend to just blur them together.
They do, and it causes so much confusion.
Yeah. In the modern framework, the capital account is actually quite narrow. It's not about huge flows of investment capital. It deals with capital transfers.
Like debt forgiveness.
Exactly. Things like debt forgiveness by bilateral lenders or the transfer of funds linked to the acquisition or disposal of non-produced, non-financial assets.
Right. So we are talking about, say, the purchase of land for a foreign embassy or the transfer of intangible assets like patents and copyrights.
Yeah, it is generally a pretty minor component of the overall ledger.
Very minor. The real heavy lifting, the actual financing of the global economy, occurs in the financial account.
Okay, break that down for us.
So this is the record of transactions involving financial assets and liabilities. If a country is running a current account deficit, the financial account is where we see exactly how they are paying for it. It encompasses foreign direct investment, the FDI, where a multinational corporation acquires a lasting management interest in an enterprise. So, say, building a new semiconductor fabrication plant.
Right, FDI is the sticky capital. It's the capital that physically anchors itself in the domestic economy. You can't just pack up a factory overnight.
Exactly. But the financial account also tracks the hot money.
Foreign portfolio investment, or FPI.
Yes. This involves cross-border transactions in equities and debt securities without a controlling stake. It is highly liquid and, frankly, highly volatile.
Because a shift in global interest rates can trigger a massive outflow of portfolio investment in a matter of hours.
Precisely. And beyond FDI and FPI, the financial account includes external commercial borrowings and the ultimate backstop of the entire system.
The official reserve assets held by the central bank.
Yes, the foreign exchange reserves. And this leads us to the core accounting identity that trips up so many students and, honestly, a lot of financial journalists, too.
Oh, totally. The source material states unequivocally that the balance of payments always balances.
Always. It is governed by the ironclad rules of double-entry bookkeeping. Every single credit transaction is offset by a corresponding debit.
Therefore, the current account balance, plus the capital account balance, plus the financial account balance, along with the category for errors and omissions to catch statistical noise, they must mathematically sum to exactly zero.
That is the mechanical reality of the spreadsheet. Like, if a nation imports $10 billion more in goods than it exports, it didn't just acquire those goods for free. It had to finance that $10 billion gap.
Right.
Perhaps it attracted $5 billion in foreign direct investment and borrowed $3 billion from foreign bond markets. That still leaves a $2 billion shortfall.
So to settle that final bill, the central bank must step in and draw down its own foreign exchange reserves by $2 billion.
Exactly. The deficit in the real economy is perfectly mirrored by a surplus in the financial financing. The net result is an arithmetic zero.
But I have to challenge the implication of that, though. Like, if the overall equation is always forced to zero by sheer accounting design, why does the concept of a balance of payments crisis even exist?
It's a great question.
Because if the ledger automatically resolves itself, why do sovereign nations default? And why do currencies collapse?
What's fascinating here is the absolute difference between an accounting balance and an economic equilibrium. A zero at the bottom of a spreadsheet provides zero guarantee of macroeconomic stability.
Oh, interesting.
Yeah. To diagnose a crisis, We really have to split the transactions on that ledger into two distinct behavioral categories: autonomous transactions and accommodating transactions.
Okay, autonomous transactions, those are the activities occurring above the line, right?
Yes, they are undertaken for their own sake, driven by profit motives, market demand, or independent policy goals.
So when a domestic consumer decides to purchase an imported automobile, or a foreign mutual fund decides to buy domestic government bonds because the yield is attractive, those are autonomous decisions.
Exactly. They happen regardless of the overall state of the national balance of payments.
Right. Conversely, accommodating transactions happen below the line. They exist solely to compensate for the imbalances generated by those autonomous transactions.
Yes, they are the shock absorbers. If the sum of all autonomous imports exceeds the sum of all autonomous exports and inward investment, the country faces a fundamental deficit. The accommodating transactions are the emergency measures required to force the ledger back to zero.
Which means dipping into the central bank's foreign exchange reserves or securing an emergency bailout loan from a multilateral institution. So the panic arises because accommodating transactions rely on finite resources.
Precisely. A country can run an autonomous deficit for a while, covering the spread by burning through its reserves, and the accounting balance remains zero.
But eventually the reserves run dry. You cannot accommodate forever.
Right. When the central bank has no more dollars to sell and the international markets refuse to lend, the accounting balance shatters the economic equilibrium. The currency goes into freefall.
That is the anatomy of a BOP crisis. It is the exhaustion of accommodating capacity. So the critical question for policymakers is not how to balance the spreadsheet today, but how to permanently alter the flow of autonomous transactions to restore a sustainable equilibrium.
Exactly. How does a nation restructure its economy so it stops bleeding reserves in the first place?
Now, historically, the assumption was that the system possessed an inherent self-correcting mechanism, didn't it?
Yeah, if we look back to the classical gold standard era, David Hume theorized the price-specie flow mechanism way back in 1752.
And the logic was brilliantly simple, but in practice, utterly brutal. Under a strict gold standard, a trade deficit meant a physical outflow of gold bullion to foreign creditors.
Because the domestic money supply was strictly pegged to the nation's gold reserves. So an outflow of gold mandated an immediate contraction of the money supply.
Right, less money circulating within the domestic economy, chasing the same volume of goods, naturally led to a general decline in the price level, deflation.
And as domestic prices fell, the nation's exports became increasingly competitive on the global market. Simultaneously, the relatively higher prices of foreign goods suppressed domestic demand for imports. The trade deficit would organically reverse itself into a surplus, and gold would begin flowing back into the country.
The theory is elegant, for sure, but the reality of a deflationary spiral is catastrophic.
Oh, absolutely. Deflation doesn't just lower the price of a loaf of bread. It lowers wages, it destroys corporate profit margins, and it exponentially increases the real burden of debt.
Yeah, so if an economy tries to rely on the classical mechanism today, they are effectively choosing to induce a massive, grinding recession just to fix a trade imbalance.
And the classical mechanism relies on the assumption of perfect price and wage flexibility. But as Keynes vehemently pointed out, wages are sticky downward.
Right, workers will fiercely resist nominal wage cuts, and union contracts lock in labor costs.
Exactly. When the money supply contracts, prices don't just smoothly adjust downward. Instead, factories simply shut down. Output collapses and unemployment skyrockets.
The cure is arguably worse than the disease.
Far worse. This inherent flaw in the price adjustment mechanism forced economists to develop alternative frameworks, which leads us to the income or absorption approach.
Pioneered by Sidney Alexander. This represents a fundamental shift in diagnostic perspective, right? Because instead of fixating on relative prices and exchange rates, the absorption approach looks at the macroeconomic aggregate.
It does. It starts with a basic national income identity. National income, Y equals consumption plus investment plus government spending plus net exports.
And Alexander grouped consumption, investment, and government spending into a single variable, which he called domestic absorption.
Right. It represents the total volume of goods and services demanded by the domestic economy. Through just basic algebraic rearrangement, we can isolate net exports. The trade balance is equal to national income minus domestic absorption.
Which makes the underlying cause of a deficit painfully clear.
Very clear.
If net exports are negative, if the country is running a deficit, it mathematically means that domestic absorption is greater than national income. The nation is literally absorbing, meaning consuming and investing, more resources than it is producing.
Is living beyond its means. Plain and simple.
And that diagnosis dictates the cure. To eliminate a balance of payments deficit, a government only has two levers. It must enact policies that either increase total national income or forcefully reduce domestic absorption.
But increasing national income in the short term is incredibly difficult, assuming the economy is already operating near full employment. You can't just mandate a sudden surge in factory output.
Right. Therefore, the burden of adjustment almost always falls on reducing absorption.
Which means the government has to implement contractionary fiscal or monetary policies. They have to raise taxes, cut government spending, or hike interest rates to crush consumer borrowing.
It's harsh. So if a government attempts to fix a trade deficit merely by devaluing its currency, the absorption approach acts as a stark warning.
It really does. Devaluation might make exports temporarily cheaper, but if the domestic population continues to absorb more than they produce, the deficit will persist.
So devaluation is utterly futile unless it is paired with expenditure-reducing policies that forcefully suppress domestic consumption.
Yes. But let's look at the mechanics of that devaluation anyway, because manipulating the exchange rate remains the most tempting policy tool for governments facing a crisis.
It's the quick fix, or at least they think it is. This brings us to the third major framework for balance of payments adjustment, the elasticity approach.
And this zeroes in on the precise behavioral response of consumers and producers when a currency actually changes value.
Right. The elasticity approach centers entirely on the concept of price elasticity of demand, the degree to which the quantity demanded of a good fluctuates in response to a change in its price.
So when a central bank deliberately devalues its currency, it instantly alters the relative prices of traded goods. Domestic exports become cheaper for foreign buyers, and foreign imports become more expensive for domestic buyers.
The assumption being that this dual price shock will automatically correct the trade imbalance. We sell more, we buy less, the deficit vanishes.
But the 2023 IES question specifically demands an analysis of why this assumption often fails. It requires us to evaluate the Marshall-Lerner condition.
Yes, the critical threshold. Let's really pin this down for the listeners. What exactly are the mechanics here?
The Marshall-Lerner condition says that a depreciation of the currency will improve the trade balance only if the sum of the price elasticity of demand for exports and the price elasticity of demand for imports is greater than 1. If both demands are very inelastic, depreciation makes things worse before the J-curve eventually turns upward.
Okay, I really want to break down the mechanics of that exact spoken translation because it is incredibly dense. We are dealing with two separate forces.
We are. First, let's look at the export side.
Right. We devalue the currency, meaning our goods are now cheaper for the rest of the world. But what if the rest of the world's demand for our specific exports is highly inelastic? What if we primarily export specialized raw materials or, say, highly specific agricultural products that foreign factories only need a fixed quantity of?
In that scenario, the foreign buyers are thrilled.
Yeah, they get a discount.
Exactly. They get to buy the exact same volume of your exports, but they pay significantly less for them in terms of their own currency. Because their demand is inelastic, the drop in price does not trigger a massive surge in the volume of goods ordered.
So from the perspective of the exporting nation, the total revenue earned from exports actually falls?
Yes, you lowered your prices, but you didn't generate enough new sales volume to offset the discount.
Ouch. Now combine that with the import side. Because of the devaluation, importing goods just became drastically more expensive.
But what if our domestic economy is entirely dependent on inelastic imports?
Think of a developing economy that simply must import crude oil to keep the power grid running, or must import advanced pharmaceutical ingredients.
Right. Regardless of how high the price spikes due to the weak currency, the domestic economy cannot significantly reduce the volume of imports. They are trapped.
So let me get this straight. The nation is earning less total revenue from its exports because foreign demand is inelastic. And it is paying drastically more for its imports because its own domestic demand is inelastic.
You've got it. The trade deficit doesn't shrink. It explodes. The devaluation actively worsened the balance of payments.
Wow. And this is exactly why the sum of the absolute elasticities must be strictly greater than 1.
Precisely. The combined behavioral shift foreigners, eagerly buying much more, and domestic citizens drastically cutting back on imports must be aggressive enough to overcome the mathematical penalty of the weakened currency.
So if the sum is exactly 1, the trade balance remains perfectly static.
And if it is less than 1, you enter a period of severe deterioration.
And that initial period of severe deterioration is what gives rise to the famous J-curve phenomenon.
Yes, the J-curve. It maps the trajectory of the trade balance over time following a currency devaluation. It visualizes the painful reality that economic adjustment is not instantaneous.
When you look at the empirical data of major devaluations, whether it's the British pound in 1967 or the sweeping structural adjustments in India in 1991, the graph almost always takes the shape of the letter J.
It really does.
The trade balance, which is already in deficit, initially plunges even deeper into negative territory before eventually finding a bottom, reversing course, and climbing upward into a surplus. Why does an economy have to suffer through the downward hook of that J before it sees the benefit?
The hook of the J-curve is entirely driven by time lags. The real economy operates on contracts, supply chains, and entrenched consumer habits, none of which can just pivot the moment an exchange rate ticker updates.
Right.
The first major friction is the recognition and decision lag. International trade is heavily reliant on forward contracts.
Okay, so if a domestic manufacturing firm agreed to purchase a shipment of specialized machine parts from Germany, say, 3 months ago, that contract is locked in.
Exactly. When the domestic currency devalues today, the firm is still legally obligated to take delivery of those parts. But now they must surrender vastly more domestic currency to acquire the required euros to settle the invoice.
The immediate effect is a massive spike in the import bill, with absolutely no change in volume.
The ships are already on the ocean. The letters of credit are already signed. You can't unring the bell on those transactions.
That makes total sense.
Even when those old contracts expire, you hit the production lag.
Right, because let's assume the Marshall-Lerner condition holds in the long run, and foreign buyers are eager to buy your newly cheapened exports. Your domestic factories cannot simply double their output overnight.
Expanding production requires hiring new labor, sourcing additional raw materials, and potentially building new physical infrastructure. It takes months, sometimes years, for the supply side of the economy to scale up enough to generate the export volumes required to improve the trade balance.
We also have to consider the pass-through lag, which introduces corporate strategy into the equation. A currency devaluation only alters foreign demand if the exporting companies actually pass those savings on to the foreign consumer.
Right. If the Indian rupee depreciates against the dollar, an Indian textile exporter might choose to keep their dollar-denominated price exactly the same.
So the American consumer sees no price change and therefore doesn't increase their demand.
Meanwhile, the Indian exporter simply pockets the massive expansion in their profit margin when they convert those stable dollars back into weakened rupees. The corporate balance sheet improves, but the national export volume remains stagnant.
All of these structural frictions guarantee that in the short run, the elasticities of demand are incredibly low. The economy is trapped in the inelastic phase.
But as time progresses, usually in the time frame of 12 to 18 months, the rigidities dissolve. Consumers find domestic substitutes for increasingly expensive imported goods.
Export-oriented factories bring new production lines online.
Old supply contracts expire and are renegotiated. As the behavioral responses become highly elastic, the Marshall-Lerner condition is finally satisfied, and the trade balance rides the upward slope of the J-curve.
So what does this all mean for a policymaker? It means initiating a currency devaluation is an act of immense political courage.
Or perhaps desperation.
True. You are deliberately subjecting your economy to a period of intensified financial pain, spiking inflation on imported goods, and widening deficits entirely on the theoretical faith that the elasticities will eventually align in your favor 18 months down the road.
And if your government lacks the political capital to survive the downward hook of the J, the policy will collapse before it ever succeeds.
Wow, and we must recognize that this painful adjustment process does not occur in a vacuum. A nation's balance of payments is merely one side of a global transaction.
Exactly. Every time an economy successfully navigates the J-curve and drastically increases its exports, it is fundamentally altering the economic landscape of its trading partners.
Which brings us to the intricate dynamics of the foreign trade multiplier and the concept of foreign repercussions. We need to analyze how a shift in trade policy echoes across the global system.
Right. In a closed economy model, the Keynesian multiplier is straightforward. An injection of autonomous spending, say the government building a new highway, becomes income for the construction workers.
Those workers spend a fraction of that income on groceries, which becomes income for the farmers who then spend it on equipment.
The initial injection cascades through the economy, resulting in a total increase in national income that is a multiple of the original spending.
But in an open economy, the power of that multiplier is fundamentally dampened. We have to introduce the concept of import leakage.
As the national income rises during that cascading process, citizens do not spend 100% of their new income on domestically produced goods. A certain fraction is inevitably spent on imported goods.
Perhaps electronics from Taiwan or automobiles from Germany.
And the moment that money is spent on an import, it exits the domestic circular flow of income. It is leaked out of the national multiplier process. The higher a nation's marginal propensity to import, the smaller its foreign trade multiplier.
I think the most intuitive way to visualize the mechanics of foreign repercussions is to imagine two people shouting across a massive canyon.
I like that analogy.
Yeah, the simple multiplier, governed by import leakage, is the sound of your voice gradually fading away as it travels through the air. But the foreign repercussions mechanism, that is the echo that comes back.
Let's trace the mechanics of that echo. Suppose country A experiences an autonomous surge in investment, triggering their domestic multiplier. National income in country A rises.
Okay.
Because their income is higher, their import leakage increases. They begin purchasing significantly more goods from their major trading partner, country B.
But wait, country A's imports are by definition country B's exports. So the spending that leaked out of country A has just acted as an autonomous injection of export demand into country B.
Precisely. That injection triggers country B's domestic multiplier. Now, country B's national income is rising rapidly.
And what happens when the citizens of country B become wealthier? Their own import leakage increases. They start demanding more imported goods.
And where do they buy them? From country A.
The shout has bounced off the canyon wall and returned as an echo. The initial expansion in country A caused an expansion in country B, which then feeds back into a secondary wave of export demand for country A.
It is a continuous, iterative feedback loop of income expansion, oscillating between the two economies until the successive leakages eventually absorb all the momentum.
This raises an important question about the fundamental philosophy of international trade. Like, if the mathematics of foreign repercussions dictate that an economic boom in your country eventually triggers an economic boom in your trading partners, which then further enriches your own country.
It mathematically invalidates the concept of mercantilism.
Exactly. It proves that international trade is not a zero-sum game. It definitively proves that you should actively engineer policies that make your trading partners wealthier.
Because the canyon echo relies on a solid wall to bounce back from. If you implement bigger-than-neighbor policies, aggressively devaluing your currency to steal export market share, or erecting massive tariff walls to crush foreign industries, you are effectively impoverishing your neighbors.
You are tearing down the canyon wall.
Right, and when your neighbors are plunged into a recession, they can no longer afford to buy your exports. The echo dies, and eventually your own economy suffocates.
And the historical record provides devastating proof of this dynamic, doesn't it?
It really does. During the Great Depression in the 1930s, major economies engaged in vicious rounds of competitive devaluation. They were desperately trying to export their unemployment to their neighbors.
And the result was a catastrophic collapse in global trade volumes, deepening the depression for everyone.
In stark contrast, during the 2008 global financial crisis, the G20 nations explicitly coordinated a massive synchronized fiscal stimulus. By expanding their economies simultaneously, they leveraged the power of foreign repercussions.
So coordinated expansion utilizes the open economy multiplier as an engine for mutual recovery, preventing a synchronized global collapse.
That is a profound structural reality.
But all of these mechanisms, the trade flows, the J-curve, the echoing multiplier, they are ultimately governed by the price of currency. The exchange rate is the transmission belt for all global macroeconomic forces.
It is.
We have talked about the effects of devaluation, but how do we diagnose whether a currency's exchange rate is fundamentally accurate to begin with?
To diagnose currency valuation, international economists rely on a framework of three distinct yet deeply interconnected rates.
Let's break them down.
The most visible, of course, is the nominal exchange rate, the NER. This is the spot price quoted on global currency markets. It simply tells you how many units of domestic currency are required to purchase 1 unit of foreign currency at this exact second.
Right, the NER is essential for financial transactions. But from a macroeconomic perspective, it's kind of a hollow metric, isn't it?
Oh, totally. A nominal rate of 80 rupees to $1 doesn't tell a manufacturer anything about their actual ability to compete in the global market.
Because it entirely ignores the destructive power of inflation.
That is exactly why we must calculate the real exchange rate, the RER. The RER strips away the illusion of the nominal rate by adjusting for the relative price levels between the two interacting economies.
It is the definitive measure of a nation's true international competitiveness. It measures the rate at which goods and services in one country can be traded for goods and services in another.
Let's run a thought experiment to solidify the difference. Imagine the nominal exchange rate between India and the United States remains perfectly frozen at 80 rupees to the dollar for an entire decade.
Okay, on paper, nothing has changed.
But during that decade, India experiences an average annual inflation rate of 8%, while the U.S. experiences 2% inflation. Because domestic prices in India are surging far faster than in the U.S., the cost to produce an Indian export is skyrocketing.
So even though the nominal ticker hasn't moved a single paisa, the real exchange rate has massively appreciated. Indian goods have become fundamentally more expensive and vastly less competitive on the global stage.
Right. If the real exchange rate is appreciating, a country is marching toward a current account deficit, regardless of the stability of the nominal peg.
This brings us to the theoretical anchor that attempts to unite the nominal and real rates. The Purchasing Power Parity Exchange Rate, or PPP.
The entire concept of PPP is built on the law of one price.
It argues that in the absence of transportation costs and trade barriers, identical goods must command the exact same price across different countries when expressed in a common currency.
And arbitrage is the enforcer of the law of one price. If a metric ton of structural steel is significantly cheaper in Mumbai than it is in New York, traders will relentlessly buy the steel in Mumbai, driving up its price, and sell it in New York, driving down its price, until the prices perfectly equalize.
It makes perfect sense in theory. The PPP exchange rate is simply the ratio of the domestic price level to the foreign price level that achieves this perfect equalization across a broad basket of goods.
It is the theoretical equilibrium where macroeconomic forces are at rest. If the real exchange rate exactly equals 1, it implies that the nominal exchange rate is perfectly aligned with the PPP rate. A basket of groceries requires the exact same expenditure of real resources in India as it does in the United States.
But the global economy is rarely at rest. If differential inflation rates drive the real exchange rate away from 1, the PPP theory dictates that the nominal exchange rate must eventually adjust to restore equilibrium.
If domestic inflation is rampant, destroying competitiveness, the nominal currency must systematically depreciate to bring the real exchange rate back into balance.
Yet, when we look at real-world data, we see currencies remain deeply misaligned from their theoretical PPP values for decades at a time. The market forces of arbitrage simply refuse to snap the nominal rate back to the PPP anchor. Why does the fundamental theory fail to predict reality here?
What's fascinating here is that the law of one price contains a fatal structural blind spot. It assumes that all goods and services within an economy can be freely traded across international borders.
You can load steel, microchips, and grain onto a cargo vessel and arbitrage the price difference.
But a massive portion of any modern economy consists of non-traded goods. You cannot export a haircut, you cannot load a taxi ride, a restaurant meal, or a piece of prime commercial real estate onto a ship.
They are geographically captive, and this is the core of the Balassa-Samuelson effect, which perfectly explains the chronic failure of PPP.
The Balassa-Samuelson theory observes a systemic pattern. Non-traded goods and services are consistently drastically more expensive in highly developed economies compared to developing ones.
Let's examine the mechanics of why that actually happens. Developed economies possess highly productive, technologically advanced traded sectors, think precision aerospace manufacturing in the U.S., or advanced robotics in Japan.
And this immense productivity allows those manufacturing firms to pay incredibly high wages to their engineers and factory workers.
But within a domestic economy, labor is mobile.
Right.
The barber cutting hair in Tokyo knows that the factory worker down the street is making a high wage. To keep the barber from quitting and seeking a job in the factory, the barbershop must raise its wages to remain competitive.
Even though the physical act of cutting hair hasn't experienced a technological revolution in a century, a barber in Tokyo uses the same scissors and takes the same amount of time as a barber in Mumbai. Their productivity in the non-traded sector is identical.
Exactly. But because the high productivity in the traded sector pulls up the average wage across the entire economy, the cost of providing that haircut in Tokyo skyrockets.
The prices of all non-traded services, childcare, retail, local transportation are structurally inflated in developed nations.
And here is the fatal blow to PPP. When we calculate the general price level of a nation to determine the PPP exchange rate, we are averaging the prices of everything, the highly traded steel and the completely non-traded haircuts.
But the international currency markets, driven by export and import demand, only care about the prices of traded goods.
Because the PPP calculation is heavily weighted down by the structurally inflated non-traded sector, it will perpetually miscalculate the true equilibrating exchange rate for international trade.
It is a theoretical compass that is permanently deflected by a magnetic anomaly. It provides a long-run baseline, but it is effectively useless for short-term policy diagnostics.
And policy diagnostics are exactly what the IES LMBP model was built for. We have assembled all the individual components, the accounting of the BOP, the mechanics of adjustment, the foreign trade multiplier, and the complexities of exchange rates.
Now, we must fuse them into a single, unified analytical framework.
This is the absolute apex of the open economy syllabus, the IES LMBP model, effectively the Mundell-Fleming model. To understand the terrifying policy traps it reveals, we need to clearly define the three distinct sectors of the economy it represents.
First, we have the IS curve, representing equilibrium in the real goods market. It maps the relationship between national income and interest rates. It slopes downward, illustrating that lower interest rates cheapen the cost of borrowing, which stimulates corporate investment and consumer spending, thereby expanding total national output.
Second, we have the LM curve, representing equilibrium in the domestic money market. It generally slopes upward. As national income expands, businesses and consumers engage in more transactions, increasing their demand for liquid cash.
To prevent the money supply from being exhausted, interest rates must rise to incentivize people to hold bonds rather than cash. The intersection of the IS and LM curves dictates the internal balance of the economy.
But an open economy cannot survive on internal balance alone. It must achieve external balance, which introduces the third component.
The DP curve, representing the balance of payments equilibrium. The BP curve maps all the combinations of national income and interest rates, where the total BOP, the current account plus a financial account, equals exactly zero.
The slope of the BP curve is the most critical variable in the entire model. Generally, the BP curve slopes upward. We know that as national income rises, import leakage increases, dragging the current account into a deficit.
To offset that deficit and keep the overall BOP at zero, the country must attract a compensating inflow of foreign capital into its financial account.
How do you attract foreign capital? You raise your domestic interest rates to offer a higher yield. Thus, higher income requires higher interest rates to maintain external equilibrium.
If we connect this to the bigger picture, the precise steepness of that upward slope is dictated entirely by the degree of capital mobility.
Which refers to the friction involved in moving financial assets across borders.
Yes. If a nation has eliminated all capital controls, allowing algorithmic trading and instantaneous cross-border transfers, it has perfect capital mobility.
In this state, the BP curve is perfectly horizontal. Even a microscopic increase in the domestic interest rate above the global average will trigger an infinite, immediate tsunami of foreign capital rushing in to capture the yield.
But the real world, particularly for emerging economies, is defined by imperfect capital mobility. Governments impose capital controls, restrict foreign ownership of domestic assets, and foreign investors inherently demand a risk premium.
Because capital is sluggish and hesitant, a small interest rate hike only attracts a trickle of foreign money. To finance a massive current account deficit, the central bank must hike interest rates aggressively. Therefore, under imperfect capital mobility, the BP curve is steep.
When the IS, LM, and BP curves all intersect at a single point, the economy has achieved a state of macroeconomic nirvana. It enjoys internal full employment and external balance of payments equilibrium simultaneously.
The central bank's primary objective is to maintain that intersection, or strategically shift the curves to achieve growth without breaking the equilibrium.
Which brings us to the Mundell-Fleming masterclass. We are going to walk through the exact, step-by-step scenario presented in the 2020 IES examination. We are diagnosing a specific patient.
Okay, here are the parameters. The country operates under a rigidly fixed exchange rate regime. The central bank is legally obligated to defend the currency peg. Furthermore, the country has imperfect capital mobility, meaning our BP curve is upward sloping.
And the government, facing a sluggish domestic economy, decides to artificially stimulate growth by executing an expansionary monetary policy. What is the precise chronological sequence of events?
The initial action begins in the money market. Step 1. The central bank aggressively expands the domestic money supply, perhaps by executing open market operations to purchase government bonds from commercial banks, flooding the banking system with liquidity.
In the framework of our model, this massive injection of money shifts the LM curve significantly to the right.
Step 2 involves the immediate domestic reaction. The new intersection of the IS curve and the shifted LM curve dictates a new internal equilibrium. Because the banking system is flooded with cash, the cost of borrowing plummets. Interest rates drop sharply.
This cheap credit stimulates a surge in corporate investment and consumer spending, which successfully drives up total national income. From a purely domestic perspective, the policy appears to be a total triumph.
But step 3 introduces the devastating external consequences. The economy is now operating at a point that is completely divorced from the BP curve. The sharp drop in domestic interest rates has made domestic bonds highly unattractive compared to the yield offered by foreign bonds.
The sluggish yet inevitable reality of imperfect capital mobility takes hold. Investors begin selling off domestic assets and transferring their capital abroad, seeking better returns. The financial account plummets into a severe deficit.
Simultaneously, the surge in national income triggers the foreign trade multiplier's import leakage. Emboldened domestic consumers significantly increase their consumption of imported goods. The current account is dragged into a widening deficit.
We are facing a double-barreled crisis. Capital is fleeing the country, and imports are draining resources.
Step 4 is the manifestation of this crisis in the foreign exchange market. The combined deficits in the current and financial accounts result in a massive overall balance of payments deficit.
In the currency markets, everyone, importers needing foreign currency to pay for goods and investors needing foreign currency to buy foreign bonds, is desperately trying to sell the domestic currency.
This creates an overwhelming excess supply of the domestic currency, placing immense, crushing downward pressure on its value. The market is screaming for a severe depreciation.
But the trap is set. Step 5. Remember the initial parameters. The country operates under a fixed exchange rate regime.
The central bank cannot simply allow the currency to depreciate to absorb the shock. They are legally, perhaps constitutionally, mandated to defend the peg.
As the market tries to sell the currency, the central bank must step in as the buyer of last resort.
To prevent the exchange rate from collapsing, the central bank must aggressively intervene in the foreign exchange market. They must open their vaults, sell off their precious finite reserves of foreign currency, and use those foreign dollars to buy up their own domestic currency from the open market.
They are artificially absorbing the excess supply to prop up the price.
And here's where it gets really interesting and where the brutal elegance of the Mundell-Fleming model reveals itself. Step 6 is the final, fatal consequence of that intervention.
Yes. When the central bank enters the market and buys up its own domestic currency, it is literally removing that cash from circulation. It is actively shrinking the domestic money supply.
The intervention directly reverses the initial policy action. As the money supply shrinks, the LM curve, which the central bank so proudly shifted to the right in step 1, is systematically forced to shift right back to the left.
It shifts back, and it keeps shifting back until the balance of payments deficit is eliminated. And the only place the deficit is eliminated is at the original starting point on the BP curve. The LM curve retreats to its exact point of origin.
The final diagnosis is a stunning policy failure. Under a fixed exchange rate regime with capital mobility, an independent monetary policy is completely self-defeating.
The central bank attempted to expand the economy, but the immutable laws of the balance of payments, combined with their obligation to defend the currency peg, forced them to systematically undo their own expansion.
The ultimate net effect on national income is zero. The net effect on interest rates is zero. The only tangible result of the entire exercise is that the central bank has incinerated a massive portion of its foreign exchange reserves for absolutely no macroeconomic gain.
It is the ultimate central banking nightmare, and it perfectly encapsulates the core thesis of the Mundell-Fleming model, often referred to as the impossible trinity or the macroeconomic trilemma.
The model mathematically proves that a nation cannot simultaneously possess three things: a fixed exchange rate, free capital movement, and an independent monetary policy capable of managing domestic growth. You can only choose two.
If you peg your currency and open your borders to capital, the global market dictates your interest rates. Your central bank becomes nothing more than a currency exchange desk.
The 1992 Black Wednesday crisis we discussed at the very beginning was precisely this trilemma executing a sovereign nation. The Bank of England tried to maintain a fixed exchange rate within the European exchange rate mechanism, while simultaneously trying to lower interest rates to fight a domestic recession.
All while capital was free to flee across the English Channel. George Soros didn't invent a complex new derivative. He simply understood the Mundell-Fleming model better than the politicians did. He knew that the Bank of England's reserves would run out before they could bend the laws of macroeconomics.
That is the level of diagnostic mastery the IES examiners expect. We have covered an immense architectural framework today. Let's synthesize the journey.
We began with the foundational accounting of the balance of payments, dismantling the illusion that a mathematical zero equates to economic stability if you're exhausting your accommodating reserves.
We examined the agonizing deflationary reality of Hume's classical adjustment and transitioned to Alexander's absorption approach, realizing that a deficit is fundamentally a symptom of a nation living beyond its means.
We rode the treacherous downward hook of the J-curve, governed by the precise mathematical threshold of the Marshall-Lerner condition and the inescapable realities of structural time lags.
We listened to the echoing canyon of the foreign trade multiplier, proving that coordinated global expansion is mathematically superior to bigger-than-neighbor isolationism. We exposed the Balassus-Samuelson effect, showing how the non-traded sector permanently warps the purchasing power parity compass.
And finally, we watched the Mundell-Fleming trap snap shut, demonstrating the absolute futility of monetary policy under a fixed exchange rate.
It is a cohesive, interlocking system. Every shock in the current account demands a reaction in the financial account, which alters the exchange rate, which feeds back into the real economy. Recognizing those feedback loops is the key to mastering the syllabus.
Absolutely.
With that in mind, and based on the historical pattern of the IES GE-02 papers, what are the distinct analytical scenarios you predict the examiners will deploy in 2026?
I strongly advise candidates to prepare for two highly specific theoretical contrast questions. First, regarding IES LMBP policy effectiveness, you must be prepared to argue the exact inverse of the scenario we just dismantled.
Okay, so proving why fiscal policy is highly effective.
Yes. Today, we proved that monetary policy is utterly useless under fixed exchange rates. For the exam, you need to rigorously construct the argument for why fiscal policy, a massive government spending initiative, is highly effective under fixed exchange rates, but becomes completely neutralized under flexible exchange rates due to the resulting currency appreciation crowding out net exports. You must be able to trace that chain reaction with the same level of granular detail.
The mirror image of the trap. What is the second major analytical focus?
Second, expect a question demanding a synthesis of adjustment mechanisms. You will likely be asked to compare and contrast the income-based absorption approach with the price-based elasticity approach. The highest marks will go to candidates who can explain why these theories are not mutually exclusive, but rather deeply complementary.
So, connecting Marshall-Lerner to Alexander.
Specifically, you must be able to articulate why the price effects of a currency devaluation, the Marshall-Lerner mechanics, can only result in a permanent improvement in the balance of payments if they are structurally supported by expenditure-reducing policies dictated by the absorption approach. You have to weave them into a single, cohesive policy prescription.
That is the difference between memorizing a textbook and diagnosing an economy. Before we sign off, I want to step back from the classical models for a moment. The mechanics of the J-curve, the constraints of Mundell-Fleming, these models were largely forged in the mid-20th century. They assumed a certain physical reality to trade and finance. But the global economy has mutated.
It has evolved into a fundamentally different organism. And this raises an important question, a highly provocative thought for you to carry into your further studies. The Mundell-Fleming model and the concept of an upward-sloping BP curve relies on the assumption that capital flows react relatively predictably and somewhat sluggishly to interest rate differentials and risk premiums. It assumes a degree of manageable friction.
But look at the modern financial architecture. We are no longer just dealing with central banks executing sovereign bond purchases or massive pension funds reallocating quarterly portfolios. We are operating in a world dominated by algorithmic high-frequency trading. We have decentralized, instantaneous cross-border cryptocurrency transfers that bypass traditional clearinghouses entirely. We see massive, unpredictable flights of speculative capital driven by social media sentiment rather than macroeconomic fundamentals.
The sheer velocity and volume of modern financial flows have become detached from the underlying physical economy. In today's markets, the total volume of speculative capital shifting across borders in a single afternoon can completely dwarf the total value of all physical goods traded globally in an entire year. The financial tail is violently wagging the macroeconomic dog. The crucial question facing modern economists is this: are the fundamental models of the 1960s equipped to survive contact with this hyper-accelerated reality? When a massive algorithmically driven capital flight can swamp a nation's current account by a factor of 100 milliseconds, does the BP curve even have time to define its slope, or does the entire model simply break under the sheer force of the velocity?
It's a terrifying prospect for a central banker. You step into the diagnostic clinic expecting to treat a complex, but ultimately predictable circulatory system based on the classical textbooks. Instead, you realize the patient's nervous system has been rewired, firing a million times faster than the anatomy chart allows, driven by forces that don't respect the old equations. The diagnostic muddy waters are deeper and more turbulent than ever before. Thank you for joining us on this massive exploration of open economy macroeconomics. Keep interrogating the models, keep analyzing the hidden friction in the global system, and best of luck with your exam preparation. Until next time.